I'm going to answer the question in the title right now, before the charts, before the data, before anything else. If you're holding 0 ounces of physical silver, your first target is 10. If you have 10, the next stop is 50. 50 ounces puts you in the top 20% of individual silver holders in the United States. 150 ounces puts you in the top 5%. 500 ounces puts you in the top 1%. Those numbers are probably smaller than you expected. I want to spend the next 18 minutes showing you exactly what they mean, and why the supply picture sitting underneath them is one of the most important stories in any hard asset market right now. Crucible markets. No paywalls, no agenda, just the data and what it actually tells us. If you're new here, drop Crucible in the comments. Let's get into it. Here's the question most people watching this are probably carrying. Silver has already moved, up around 160% in 12 months, sitting near $84 an ounce right now. If you haven't been in it, you're probably wondering whether you've already missed the trade. It's a fair question, and I want to give you an honest answer rather than a comfortable one. Whether you've missed it depends entirely on why it moved. If this was a sentiment-driven spike, momentum chasers, short-term positioning, news cycle noise, then yes, you look for a pullback and time your entry. But if it was driven by something structural, something in the actual supply and demand math that doesn't reverse, then did I miss it is the wrong frame entirely. So let's look at the supply side, because that's where the real story lives. Well, the global silver market has run a structural supply deficit for 7 consecutive years. That means demand has exceeded what mines can produce every single year since 2018. The cumulative shortfall between 2021 and 2025 alone is roughly 820 million ounces. To put a human number on that, it's the equivalent of 10 full months of all global silver mine production, just consumed, used up, and gone. And here's the part of the supply story that most coverage glosses over. Mine output isn't just flat, it has actually declined about 7% since 2016. You're not dealing with steady supply against rising demand. You're dealing with shrinking supply against rising demand. Those two lines don't come back together quickly. New mines take 7 to 10 years from discovery to first production. That's geology. You can't legislate your way around it. So where is all this silver actually going? Into things that are hard to argue with. Solar panels, electric vehicles, AI infrastructure, semiconductor chips. These aren't speculative demand stories. They're already running at industrial scale, and they're all growing at the same time. Take solar. The European Union alone is committed to 700 gigawatts of solar capacity by 2030. Each panel contains roughly 20 grams of silver. Run those numbers, and you get a sense of what that single policy decision means for physical demand. And China increased its solar capacity by 45% in 2024 alone in a single year. Now, electric vehicles add another layer. Each EV requires somewhere between 25 and 50 grams of silver. In the battery management system, the power electronics, the charging contacts, that's 60 to 80% more silver per vehicle than a traditional combustion engine car. With hundreds of millions of EVs mandated across major economies by 2030 and 2035, the demand trajectory isn't speculative. It's already written into law. Well, then there's the property of silver that makes all of this harder to solve than it looks on paper. Silver is the most electrically conductive element on the periodic table. In high-performance applications, solar conversion efficiency, EV safety systems, AI chip performance, you simply cannot substitute something cheaper when the price rises. The physics won't allow it. Economists call this price inelastic demand. What that means in plain terms is that industrial buyers have to keep purchasing silver even as the price climbs, because the alternative is a product that doesn't work as well. The laws of chemistry don't negotiate with budget committees. A combination, shrinking mine supply, growing irreplaceable demand, and a 7-year accumulated deficit, is the foundation underneath the price move you've been watching. But here's what the supply deficit story alone doesn't tell you. We are in 2026. Central banks around the world have spent 15 years holding interest rates near zero to keep their financial systems functional. The bonds that banks loaded up on during that period are now sitting deep underwater, worth significantly less than face value in a higher rate environment. The system is carrying that weight quietly. Here's why that matters for how you think about silver. The digital digits sitting in your bank account are not money in the way most people assume. They are a claim on currency, and that claim depends on confidence. Confidence that the bank will honor it, that the currency will hold its purchasing power, that the system will stay intact. Confidence is not a hard asset. It is a shared agreement that can change. Governments around the world are actively developing central bank digital currencies, CBDCs, that can be programmed with spending restrictions and expiration dates. A bank account can be frozen with a keystroke. A savings balance can be diluted through inflation before you've spent $1 of it. A 100-ounce bar of silver in your possession has none of those vulnerabilities. No bank can freeze it, No government directive can delete it. No inflation policy can debase it. It is what it is, a fixed quantity of a real element that the Earth holds a finite amount of. That's not ideology. That's just physics and property law. All right, here's the actual framework for finding your number. Most financial advisors will tell you to hold 5 to 10% of your portfolio in precious metals. That's a starting point. But there's a second way of thinking about this that I find more grounding, especially for physical silver. Think in months of living expenses, not portfolio percentages. The question becomes, how many months of your actual life have you protected in real money that can't be inflated, frozen, or digitally restricted? The math is straightforward. Take your monthly expenses and divide by the current silver price. At $84 an ounce, if your monthly expenses run around $3,500, you need roughly 42 ounces to cover 1 month. 125 ounces covers 3 months. 500 ounces covers a year. That is your floor, not your ceiling. Your floor, the baseline below which you are genuinely exposed to whatever happens to the purchasing power of the currency sitting in your bank account. Now back to the numbers I gave you at the start. Top 20% of individual silver holders in the United States, 50 ounces. Top 5%, 150 ounces. Top 1%, 500 ounces. Today's prices, 500 ounces is roughly $42,000. For the most powerful economy on Earth, that is the bar for the top 1% of people actively protecting themselves with physical metal. That tells you something sobering about how few people are actually doing this. The vast majority of working adults, people with decades of savings, retirement accounts, mortgages, hold essentially zero physical silver. They hold claims on currency that has lost meaningful purchasing power every single year for the last 5 years running. There's one more data point I want to put in front of you because it's still flashing. The gold to silver ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. In early 2025, that ratio hit a 105 to 1, one of the most extreme readings on record. It was signaling clearly that silver was dramatically undervalued relative to gold. Since then, the ratio has compressed down toward 60 to 1 as silver outperformed gold, platinum, and Bitcoin over that stretch. That compression was significant, but here's the context that matters. Historically, going back to 1971, the ratio has averaged somewhere between 50 and 60 to 1. If it returns to its longer historical average of 30 to 1, or the geological ratio of roughly 15 to 1, that reflects how silver and gold actually occur in the Earth's crust, we're not talking about incremental price moves. We're talking about a structural repricing. At $500 gold and a 30 to 1 ratio, silver would be priced at $170. At 15 to 1, it's $340. Those aren't predictions. They're just the math of what ratio compression looks like. Whether or not that happens depends on the same supply and demand fundamentals we've been walking through. But the ratio is still historically elevated. The signal hasn't gone away. So where does that leave us this week, in March 2026? Earlier this week, silver pulled back towards $79 on profit taking. That dip was absorbed in hours. The market is now climbing back toward $90. That pattern, shallow dips being bought quickly, is what a market with genuine underlying physical demand looks like. It is different from a speculative spike, which tends to retrace more slowly and more deeply. The geopolitical picture is adding a safe haven layer on top of the industrial and supply story. Naval engagements and oil price volatility in the Middle East are pushing institutional money into hard assets. The industrial deficit and the safe haven premium are operating simultaneously. And here's the institutional signal worth paying attention to. In just the first half of 2025, capital flows into silver-backed exchange-traded products exceeded 95 million ounces, already more than the full year total for 2024, achieved in 6 months. The large pools of capital are positioning. That is a documented public data point, not an opinion. The pattern in every major precious metals bull market runs the same way. Institutions move first, quietly. The price begins reflecting it. Mainstream coverage arrives. The public enters late. The people who were early look like geniuses. The people who waited for confirmation are buying at prices they wish they'd seen 6 months before. Bank of America has a 12-month silver price target of $60,000, set when silver was trading well below today's levels. BNP Paribas is projecting $100 by end of 2026. Both of those may need to be revised upward. The fundamentals haven't softened. 4 things. That's all I want to leave you with. Number 1, count ounces, not dollars. The dollar is a variable, the ounce is a constant. Your goal is a number of ounces that covers a meaningful floor of your monthly life, not a dollar value that feels comfortable. Number 2, prioritize physical over paper. ETFs and mining equities have their place, but in a genuine supply stress event, the paper price and the physical price can diverge. The metal in your possession has no counterparty. That distinction matters most precisely when it is hardest to act on it. Number 3, build systematically, not emotionally. If you have 0, start with 10 ounces, get to 50. Then push toward 150 and 500 as your financial situation allows. Buy on a schedule. Buy more when prices pull back. Do not try to time the exact bottom. The structural thesis doesn't depend on perfect timing. Number 4, understand what volatility actually is. Silver is a small market with heavy paper trading layered on top of it. Short-term price swings are amplified. A 10% drop in a week doesn't mean the supply deficit reversed. It means the paper market had a bad session. If the physical picture hasn't changed, your read on the situation probably shouldn't either. Here's where we are. 7 consecutive years of supply deficit, mine production declining, industrial demand from solar, EVs, and AI infrastructure growing faster than supply can match, a gold to silver ratio still historically elevated, with room to compress, institutional capital flowing in at a pace not seen before, and a banking system carrying structural weight that most ordinary savers haven't been asked to think about. None of that resolves overnight. Markets absorb pressure slowly and sometimes messily. The timing of how this plays out is genuinely uncertain, and I won't pretend otherwise. But the supply math is not uncertain. The industrial demand is not uncertain. The institutional positioning is documented and public. These aren't projections. They're conditions that already exist. Silver was money before any government on Earth existed. It will be money long after the current systems have been renegotiated, restructured, or replaced. No active legislation, no banking system failure, and no digital reset changes what silver fundamentally is. So I'll ask you one last time, and I want you to sit with it after this video ends. How many ounces of silver are you actually holding? If the answer is 0, today is the day that changes. If the answer is not enough, then you already know what to do. Build the position, do it systematically, and do it while the system still makes it easy. Subscribe to Crucible Markets. We cover the warehouse data, the COMEX flows, the physical premiums, and the macro picture that connects all of it without the noise. The link to our full 2026 silver deficit report is in the description. Stay skeptical, stay prepared, do your own homework,